Yeah, so 2022 has been a fascinating year with a lot of competing narratives. But at the end of the day, it's been a couple big picture items. And I think mainly it's been about the Fed, right? In 2021, it was all about the Fed talking about raising rates. In 2022, it became the reality of the Federal Reserve actually raising rates. And I think that certainly shocked the system in a lot of ways as risk assets rolled over, finishing 2021 very strong. And the first half of 2022 has overall been fairly weak. But what happens after a number of pretty significant rate hikes have played out, all of a sudden, at some point, stocks become cheap enough that investors are starting to get drawn in. I think as you go into July and August, there's a significant probability that you see some short-term strength. If this is the end of a bear market phase and into the beginning of a bull market phase, you tend to see leadership from a couple key areas, technology and consumer discretionary in particular. So that is what I would sort of be looking for going into the second half of the year. The challenge, I think, facing the S&P is the prospect of higher rates is still there. That's going to continue to play out through the course of 2022. And seasonally, we're sort of going through the seasonally weakest part of the year, and a lot of markets tend to bottom sort of that September, October timeframe. So while I think the market could finish the year fairly strong, I think there's still going to be some choppiness and elevated volatility in the second half of the year. As always, it's a really good time to stay diligent with stops and focus on the longer term trends.
Generally, our view is that the market has gone a long way to pricing the Fed funds hikes that created a pretty significant downdraft in valuations over the course of the last 6 months. The next 6 months will likely be characterized by a market that is absorbing the realities of a struggling economy. So as earnings estimate revision weighs on stocks, you can see segments of the market come under a significant degree of pressure, but we do believe the worst is likely past for the index.
What Asbury Research is looking for on the S&P, which is my firm, is we believe that the U.S. stock market is feeling around for what I'd call a strategic bottom. Strategic for us means one or more quarters. So somewhere in here, we're trying to rally off of the mid-June lows right now, and that could very well be the bottom that I'm looking for. But let's say we do have another leg lower. There's a lot of things going on with the Fed and China and Ukraine. So if there is another leg down somewhere near those June lows, I'm expecting to be a pretty good tangible bottom that I think could take us through the end of the year.
Well, to start the year, we have Market Vision. We have an annual event, Market Vision 2022, obviously was this year. We held it back on January 8th. And what I said then, I'm going to stick to now. I thought the first 6 months of the year was going to be very rough, and the second half of the year was going to be very strong. And I actually had pointed out a chart on the S&P 500 showing that I thought in the first 6 months we could drop anywhere in the neighborhood of, I don't know, maybe down to the 3,500 to 3,800 range. And we hit a low of 36 back on June 16th and 17th. And at that point, I called a bottom. I thought the bottom was in, and I really expected that we were going to have a really nice rally heading into the end of the year. And that's exactly what I see now. So I'm looking for this secular bull market to resume now that we have a cyclical bear market out of the way. And I think we could get back close to the highs that we saw at the beginning of the year by the end of the year. So that's primarily what I would be looking for. Again, it's almost like expecting a little bit of a V bottom where we go straight down, hit that bottom. I think the Fed is probably done with its interest rate hikes. I think that will help. I think the inflation story is dead or dying. I think that's going to help. And I think the attention is going to be turned to the recession and possibly even deflation in the second half of the year. So I'm expecting rates to come down. And as rates come down, I think these valuations on many of the growth stocks go higher. So that's the reasoning why I believe we're going to see prices rebounding into the second half of the year and throughout the second half of the year.
I think the volatility that emerged in the first half of the year is unlikely to be repeated in the second half of the year. And that's mostly because the source of the volatility was interest rates. Our view is that the market has largely priced the path of interest rates that is most likely going into the end of this year, with valuation compression over the course of just the last year, equivalent to 3 years of valuation compression between 1999 and 2002. So with that in mind, we expect that the market will calm somewhat. While that doesn't necessarily mean a super rosy outlook, it does mean at least a choppier market with less volatility than we saw in the first half of 2022.
Right. So with volatility, I tend to think of it in terms of what I call volatility regimes. And it's usually about a 6 to 9 month period where the VIX will sort of fluctuate in certain levels. So if you think about 2019 to 2020, relatively low volatility, right? The VIX remained kind of below 20, often got down to 10, if not a little bit lower into single digits. 2020, during the drop in the first quarter, you had the VIX spike up into the 80s and then settle back down to a relatively elevated period, sort of in that 20 to 40 range. 2020, stronger bull market phase driven by the Fed's liquidity and much lower volatility. 2022 has been the opposite. We're back to sort of the 2021 post-market drop sort of environment. So even if the market rallies, which I think we certainly could see that at parts of 2022 in the second half of the year, I think volatility is going to be here for quite some time. I don't see the conditions that would minimize volatility, which is what you saw in 2021. That I think was driven in a lot of ways by that persistent upward force that the Fed's liquidity, bond buying program, quantitative easing, whatever you want to call it, that provided a continuous bull market phase with relatively low volatility. I think in this environment with rising rates and still plenty of uncertainty with a lot of difficult narratives out there, I think volatility is going to be elevated and probably relatively uncomfortable, VIX above 20 for most of 2022.
No, I don't. I think volatility is done. If you look back at each low that we posted in 2022, every S&P 500 low that is, you'll see that the VIX volatility index actually came down. So as we were going lower throughout the year, volatility or the expected volatility was dropping. So it tells me that the fear was already coming out of the market as we were going lower. And now as we turn higher, I expect the VIX is going to break down. And in fact, on a chart of the VIX, if you go back and you look in, I think it's October, maybe November of 2021, and then look again at the beginning of 2022, and then the beginning of April of 2022, and you connect the trend line, you'll see that the action on Friday, July 29th, actually saw a close beneath that trend line. So I think the VIX is just now breaking down. And while we'll have periods of volatility, I don't think it'll be anything like the first half. I think we'll have pullbacks along the way in the S&P, which will result in the volatility spiking from time to time. But I think overall we go lower on the VIX right through the end of the year.
I do. I just think a lot of this has to do with geopolitics. Again, we've got a situation that's starting to escalate in China, in Taiwan. We have a Fed meeting later today. We have a mid-year election coming up, and behind all this, my opinion is there's a lot more algorithmic trading going on. That's most of the volume that we see every day, and that's changed the market, in my opinion. What I'm talking about is we're up 100 today, and then we're down 100 tomorrow, and we're up 50 the next day. There's a lot of day-to-day volatility, I think, that is, already increased because of the algorithmic trading, and it's just been exacerbated by there's so much geopolitics kind of swirling around the market now, and it's going to be here until the end of the year, certainly with the election. So yes, the answer is yes for a number of reasons.
Our S&P 500 sector strategy reflects a combination of price momentum, earnings momentum, and valuations. Right now, it's still pointing toward value-oriented cyclicals as best positioned in the S&P 500. This means a combination of energy, industrials, financials, and materials are most likely to outperform.
So me trying to look through all of this geopolitics and volatility that we talked about and try to pick out that sector, I'm just not that smart to be able to do that. And I don't think a lot of people are. So I actually built a model about 10 years ago called the SEAF model. It's SEAF, it's Sector ETF Asset Flows is what the acronym stands for. And what it does is it follows the asset flows around the 11 sector spiders, which together represent the S&P 500. For example, early in the year, from January 4th to I think about the middle of June, energy showed up in the model. It showed that there was money there, and it was sustained money. It stayed there until the middle part of June, and we were overweight that whole time. During that time, energy outperformed the S&P 500 by 40%. Did I know that? Did I know the reason for that on January the 10th? I had no idea, but the money started to go there and it stayed there. I could tell you right now, our model is overweight healthcare since about the middle of March, and technology for the past couple of weeks. Hopefully the money stays in one of those two, and I'll let the market do its thing, and we'll have a really nice outperformer in the back half of the year like we did in the beginning. But that's what I do now. I really try not to get too far over my skis, and it's hard enough just to forecast if the S&P 500 is going to go up or down. Trying to pick that sector, I can't do that unless I'm watching data, and that's really what we do here is just follow the money.
Without a doubt, I like technology. Again, I like to follow the relative strength of all the sectors. And the last two times, if you look at a weekly XLK chart relative to the S&P 500, and you go back 5 years, you'll see that there have been 3 times when the relative strength of the XLK versus the S&P 500. So if you're charting it, you just type in XLK : $SPX, put that on a 5-year weekly chart. And I like to use a line chart. And what you'll see is that the weekly PPO goes negative 3 times. It did so back in 2018, the fourth quarter of 2018 during the trade war and that cyclical bear market. It did it again back at the beginning of 2021 with all of the inflation fears. Technology got hit really hard. We saw that weekly PPO go negative there. And then, of course, this year with the cyclical bear market, we've seen that relative weakness go negative, that relative PPO go negative. Each of the last 2 times, as we've turned back higher and crossed the PPO signal line, that is what's really led the start of a huge rally in technology shares. So we saw that back at the beginning of 2019. We saw it again in May, June. Actually, it was more June of 2021. And I'm just now seeing it again with a real nice relative rally in technology. Also, in secular bull markets, technology tends to be the absolute best performing sector by a mile. So I'm looking for the second half of the year to be very strong, and I think it's going to be led by technology.
This is a really tough one, I would say, overall. And when I'm thinking about sector returns, I have to go back to Sam Stovall's idealized cycle of sector leadership. So if you think about sort of market regimes, right? When you have sort of late cycle bull market phases, you have things like the MEI trade, energy, materials, industrials that tend to do very, very well. As the market's deteriorating, you tend to get leadership from more of the defensive areas of the market, sometimes healthcare, often consumer staples, utilities especially, which on a relative basis have actually been doing pretty well in some parts of 2022. As the market is bottoming, and I don't know exactly how we will get from where we've been with the S&P bouncing off of the 3,600s to just above 4,000 here in late July. I don't know exactly what the trajectory will be, but I'm fairly confident we're going to see strength in stocks on a cyclical basis. And I wouldn't be surprised if the end of the year is fairly strong relative to what we've seen many times in previous years. And if the S&P is going to get from 4,000 up to 42 or 44 or even 4,600 or greater, which I think it certainly has the potential to do it, it's hard to imagine that would be driven by anything other than the FANG sectors. That's technology, consumer discretionary, communications, services. I would probably lean into technology as my best opportunity here. I certainly could see energy and some other sectors doing very, very well. But given the beaten down nature of technology, if the market recovers from here, particularly out of a low in the fall, I think technology is probably going to drive that more than anything else.
Our view on interest rates is they will most likely continue to rise on the short end as the Fed continues to increase interest rates to catch up with inflation reality. However, I do wonder if in the second half of this year, we might finally see our trough in the yield curve spread. While most analysts are anticipating very little change to the yield curve spread has done a very good job of predicting economic recession. It usually troughs out before the economy turns into recession. So I would anticipate that might be the surprise factor coming from the yield curve into the second half of this year.
So interest rates have been the story among many in 2022. I was interviewed at the beginning of the year when I was asked for one chart to navigate 2022. And mine was a chart of the 10-year, which is $TNX on stock charts. That tells you most of what you need to know about what has happened to risk assets, about the actions of the Fed and how that's been reflected in the interest rate environment. The strength of commodities, the inflationary pressures, leadership trends between growth and value stocks. All of that has been reflected, and I think drawn very much from things like the dollar and other things, but particularly the 10-year yield. What's happened is the 10-year yield has spiked up pretty well. And while I think over the long term, rates over time are going to be higher and higher. One of the charts behind me on the wall is a chart of interest rates going back for decades. And we've been in this, bull market rally in bonds for decades, really since the 1980s. You've seen this big downtrend in rates. So even though rates are up a lot and the 10-year is up around 253% during the course of 2022, that's coming off of pretty low levels, sub 1%. And while we've eclipsed or reached the level from 2018, which is a significant one, I do think higher rates are most likely over time. However, the fact that rates have come up so much, we have an inverted yield curve right now. I see the 10-year coming off a little bit. I think it's going to chop around most likely in sort of that 2.5% to 3% range for the remainder of 2022 before resuming that long-term uptrend in rates. I think bonds are going to be a tough area of the market for some time here.
Interest rates, specifically the yield of the 10-year, to me, just looking at the chart is a lot easier than looking at a chart of the S&P 500, simply because there's less noise. The global interest rate market can't be pushed around day to day like you see in the S&P 500, like you see in the stock market. 3.25 was a big level. I think that dates back to October of 2018, if I'm not mistaken. It was a big peak, a big important peak that sticks out on the chart at 3.25. Again, this is the yield of the 10-year. My work suggests, our work here at Asbury suggests that is a tangible top. And I think the fact that the 10-year rate has actually fallen well below 3% over the past few days, I think it's 275-ish right now. I see that going down to about 225, 230. So I think the top is in for the year. I think the market has priced in early on. That's what the market does. It prices things in early, ideally, and then that particular market can kind of move away from the peak once the initial shock of interest rates going higher starts to subside a little bit. So I think 3.25 is probably it for this year. And I think before we're through with this move off of 325 in the 10-year, I think somewhere under 250, if I had to guess and make an exact, I'd say 225 on the yield of the 10 is probably coming up the next 1 to several months.
I think they're coming lower. We've been rising for a while. The Fed's been very hawkish. I think maybe first it depends on whether you're looking at the short end of the yield curve or the long end. For the short end, I'm talking about the 1 month, and that generally tracks the Fed funds rate and what the Fed is doing. I believe the Fed just raised for the last time. I don't think they'll raise again. I think that the hikes that they've put into place here over the past several months is going to finally start to work in terms of slowing down the inflation rate. The inflation rate already has slowed down, actually. If you look at a 12-month rate of change on the core CPI, it peaked back in March. And that's one of the things I talked about back at Market Vision 22 in January, was that I expected March was going to be the high as we go forward. And that has proven at this point to be the high, and it's rolling back over. And if the Fed doesn't have to worry about inflation, once that starts to come down, they're going to turn their full attention to the recession and possibly even deflationary pressures later this year, because I think inventories are going to build with the lack of demand from a slowing economy. So as we fix a lot of the supply chain issues, there are going to be a lot of companies that are going to be building inventories and then going to be no one to sell them to because the economy is going to slow so much. So I think there could be deflationary pressures later this year, which takes the Fed funds rate lower. I think the Fed starts to cut by the end of the year, maybe early next year. And if you look on the long end, we're already seeing the 10-year Treasury yield drop tremendously. Again, on Friday the 29th, I saw what looks to me to be a breakdown of a topping head and shoulder structure on the 10-year Treasury yield, the $ TNX. So that measures down almost to 2%. And currently we're at about 2.66%, 2.67%. So I'm really looking for a pretty substantial drop in interest rates through the second half of the year. And I believe that's going to coincide with a big rally in stocks and in particular, those technology names.
We see the greatest valuation opportunity for long-term investors emerging in small cap US stocks as well as emerging market equities. These two components of the global equity landscape are trading at multiple standard deviations below long-term average. And while price momentum trends have yet to really support the case for these stocks, we have seen emerging signs of stability over the course of the last several weeks. So we'd be watching for that price momentum to start to turn to confirm the valuation opportunity that has emerged.
Well, I've been changing my strategy really throughout 2022. I went into the year believing that we were topping. I thought there was way too much risk in the market to remain on the long side. So I picked my spots in the first 6 months of the year to short, mostly with the QID, which is the leveraged ETF that tracks the NASDAQ 100. I thought those were the stocks that would get hit the hardest, and they were. But after calling the bottom in mid-June, I've been fully invested. I mean, from my daily market report that I sent out to members back on June 16th, and this is a quote, I said, I'm calling the bottom right here and right now, and am fully invested. And I asked the question, am I right? And I said, I'm comfortable letting future action prove me right or wrong. And so far, I think the NASDAQ is up roughly 17% off that bottom in just a little bit more than a month. And I think we're going a lot higher. So I would say at this point, kind of lost my train of thought there. You have to edit this. Okay. So what I'm looking at now that we've already rallied, is I'm going to stay away from the QQQ and the QLD primarily and work with individual stocks. I believe the market's bottomed. I think we're now getting the price action in the S&P 500 to confirm that bottom. And so I'm much more interested now in starting to focus on individual stocks. And when it comes to individual stocks, I'm literally just trying to manage my risk. I'm trying to improve my odds. And quite honestly, I'm just trying to make money. So I'll be looking at individual stocks that pull back. Not all stocks, even if we are in an uptrend, not all stocks are going to go up every day. I think there'll be pullbacks. There'll be plenty of opportunities to enter some low risk trades with tremendous upside potential. I'll begin to swing trade again, which I haven't done since 2021. And so that's really the theme I'm looking for, or that I'm planning to trade in the second half of this year. I believe we are resuming the secular bull market, and I'm prepared to trade individual stocks again.
Again, we are data driven, so I might see a really good idea out there, and I see funds starting to go there, money flow starting to go there, outperformance starting to come out of that sector. If that changes 3 weeks from now, we're not the kind of shop that's going to double down or say, listen, things have to go this way. We just move with the market. But right now, I've got a short list here. I mentioned healthcare. We also currently like biotech and pharma, which are kind of all in that space. Technology, I had already mentioned. Small cap stocks, for the first time in a long time, they're starting to outperform. They're starting to break some resistance. Specifically, I'm talking about the Russell 2000. That, if it happens, I think would be good for the market. And finally, we had been overweight value stocks from the end of last year, the end of 2021, till about 2 weeks ago. And our models have recently shifted to growth. So we also like growth. So if you look across the spectrum, again, healthcare, biotech, pharma, kind of all in that same space, technology, small cap, and growth. And if you look at bigger picture, it looks like if those come true, or if most of those actually come to pass and keep outperforming or keep doing well, that would kind of indirectly back up my current contention that the yield of the 10-year has set a multi-month peak at 3.25. Yields are going to start to come back in a little bit, and the stock market's going to find a bottom as more risk appetite shows up in the market. So all of these things we talked about today, they all kind of dovetail together, which makes me feel a little bit more confident about the theory.
So as always, I'm a proponent of using relative strength, which is focusing on how a stock or industry or group or sector is doing relative to anything else. When you're looking at something like futures, it's pretty much a buy-sell decision, right? Do I buy or sell this contract at this moment? When you're an equity investor, though, when you buy one stock, you are also choosing not to buy thousands of other names. And so that's part of the decision. So relative strength is key because it tells you whether or not you're looking at the right opportunity versus all the other ones you could do. So having said that, I would focus on areas of the market that are outperforming, where relative strength, looking at that stock or group versus the S&P, where that line is rotating higher. I would never be unhappy owning stocks that are outperforming in a bull phase, in a bear phase, anywhere. So that would be the main thing for me, is focusing on stocks with high scooter rankings, stocks with improving relative strength. I think that's going to serve you well in through the remainder of 2022. Having said that, where would I expect opportunities to most likely be? I think there's a period where some defensive options are probably going to make sense. Consumer staples are an area of the market that I think at this point are still looking strong. Even though the market's bounced, you're seeing things like brewers and beverages and others in the consumer staples sector doing pretty well. I would also be looking for opportunities in some of the FANG sectors like technology, like communication services. There are a lot of stocks that have been broken down and are starting to improve. And you can tell that they're improving by the fact that they're not making new lows and they're starting to make new swing highs. Most importantly, the momentum is improving. That's what draws me to charts like Apple and Microsoft. And below there, I think semiconductors and other areas of the market where you see improvement. Final thing I would say is healthcare. Healthcare is a really interesting sector because it's sort of agnostic. Healthcare does well in up and down phases because it's kind of offense and kind of defense. And when I'm scanning for new ideas today in late July, I'm seeing a lot of opportunities in healthcare. So I would look for names that are showing improving trend and improving relative strength. Things like equipment and supplies within healthcare could fit that description.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.